Hello, and welcome to the September edition of the Optimised Monthly Energy Market Insights. I'm David Schofield, I'm Head of Energy Markets and Trading here at Optimised, and I'm going to be talking you through the latest developments. Just a quick note before we start, we now have a new report format designed to provide clearer insights into market fundamentals and geopolitical developments, so please take a look at this month's report. Now, let's take a closer look at September's developments. In the gas market, September opened up on firmer ground, but quickly lost momentum, with prices ending the month broadly stable and posting only marginal gains. European storage climbed above 82%, providing a strong buffer as winter approaches. Norwegian flows recovered steadily following their maintenance period, and muted Asian LNG demand meant that additional cargoes were available for Europe. Later in the month, the easing of French LNG strikes added some further confidence to supply conditions. UK power mirrored the gas closely, with liquidity concentrated around the October baseload contract, which saw heavy trading before expiry. Liquidity beyond the nearer seasons was limited. Wind generation was relatively variable, peaking above 14 gigawatts at times and dipping below 2 gigawatts at others, contributing to some short-term price volatility. The carbon markets largely followed the broader energy complex, though UK allowances diverged from their European benchmarks late in the month, widening that EUA-UKA spread. Speculative fund positioning added to this volatility. Oil prices trended lower as Brent approached that $65 per barrel, weighed down by expectations of further OPEC Plus output increases, despite ongoing risks related to Russia. In Europe, France aligned with the US, signalling further sanctions against Russia if no progress was to be made on peace talks. Ukrainian drone strikes on Russian oil facilities underscored the region's security risks, while EU leaders reaffirmed that the 2027 deadline for phasing out Russian gas, resisting calls to accelerate that timeline. In the Middle East, Israeli strikes on Qatar escalated regional tensions and drew widespread condemnation. Washington's attempts to broker Kurdish oil exports through Turkey faltered, highlighting fragile diplomatic leverage. At the same time, debates with OPEC Plus reflected divisions between members, even as cautious consensus was maintained. Globally, China strengthened strategic alignment with Russia, signing new gas purchase agreements and accepting sanctioned LNG deliveries. Meanwhile, US-led allies weighed fresh sanctions on Moscow, reinforcing that increasing fractured geopolitical order. Looking ahead, October will mark the official start of the heating season. The pace of European storage withdrawals, colder weather risks, and the trajectory of sanctions on Russia all represent potential upside risks. Conversely, stronger renewable output or higher OPEC production, they could cap price growth. Overall, volatility looks set to continue as markets remain finely balanced between fundamentals and geopolitics. That concludes September's edition of the Monthly Energy Market Insights. Thank you for listening, and I look forward to sharing October's update with you.